Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Phil, welcome back and welcome to episode 2, I should say.
Thank you. Thanks for having me.
Episode 1, we talked about like an introduction to personal insurance, how it's different to things like car insurance, general insurance that is in that category, and things like health and hospital types of cover. We're talking about things like life insurance, income protection, those types of things. If you haven't already listened or watched episode 1, you don't necessarily need it for this episode, but it may help you get some context on things. In this episode, we're going to narrow in and we're going to focus on life/death cover, trauma, TPD, and child's cover is the kind of the topics for this. And you've grouped them together as kind of lump sum insurances, or we have. I was going to start off in a bit of a fun way, actually, Phil. Last week, we were due to record this episode. We were due to record a bunch of episodes together, and I sent you a message and I said, I can't talk because I've lost my voice completely. Is there such a thing? Is there such an insurance that could help a podcaster like myself avert such crisis? Like if I got laryngitis and it went for like a year, what would kick in? Anything?
Yeah. None of these lump sum covers would kick in under that case. The income protection, which is episode 3, would kick in if your income and being a business, if your business income did suffer and your personal income did suffer because you literally can't record podcasts and they make up a big portion of your revenue, then you would get paid an income protection policy, or you'd be on claim for that.
Okay. I think that's something that I need to keep in mind then, because this is the first time I literally woke up when we were due to record. That morning I woke up, nothing was coming out of my mouth when I was moving my lips. It was a whole thing and I could not believe it. And you made a joke that it's probably one of those really important things in our business. So in the last episode, I did ask you a few questions about why you would go through a financial advisor to get insurance. And you mentioned things like there are more products, so there's more on the menu if you go through an advisor. It's not necessarily more expensive. You can access better products. And there are many different things and reasons why you would do that. But you and your team at Skye, you've got heaps of great financial advisors that specialize in this stuff. We did mention in the last show, there was a comment about how you get paid. So people now know that we have a partnership between Skye and Rask. And there was a wonderful comment in our community from Yen, one of our early adopters in the community, and I've got it here in front of me. They say that, and I'll quote, "I'm currently in the process of researching options for income protection and total and permanent disability insurance. On the outset, I want to note that I believe every business should be free to legally charge fees/receive commissions however they like. However, in turn, I believe customers have every right to freely and informatively choose what they wish to pay for varying levels of service." Whilst I was in my rabbit hole of financial services guides, which is a great thing, not many people understand what an FSG is, but for finance businesses, it is the document that tells you what they do. They go on to say, I am seeing initial and ongoing trailing commissions for which I am not a fan of. Some businesses also charge a flat fee in addition to these commissions, not quite the fee for the service that I thought. They go on to say, I'm trying to discover alternative options of paying an upfront fee for advice/purchase and for me to receive rebates of the commission. I have no qualms with paying high upfront fees if I can see a nice payback over the course of the term. Now, they did say a bunch of other stuff, but it's a great comment. And Phil did answer it in the community. So thanks for doing that, Phil. But for everyone's benefit here on the podcast, why is the structure of a commission structure appropriate for insurance in your opinion? Let's go with that.
Yeah, so I mean that's our business model. We we prefer, there is an option to do a fee for service, and there are some limited financial advisors who do it, and it was a big trend actually, 10 to 5 years ago. A lot of advisors were doing that and thinking it's the way of the future. We want to do it that way. And we when I wasn't doing much insurance, when I was holistic advisor, it kind of made sense to some clients. But now this is kind of all we do. The reason I believe that it is in clients' best interest to have that built-in commission is because if you go to the insurance company directly and not through a financial advisor, as I said, there's not many that do it, but the ones that do it, they charge you the same premiums as if you went through the advisor and with the commission built in. The issue and concern when you don't have any commissions on your policies is any adjustments or changes. Unfortunately, in today's market, and it could change in the future, but today's market, insurance companies don't want to work directly with clients one-on-one. They won't allow you to increase your cover with them because that's seen as financial advice. They're not licensed to provide financial advice. So there is this complexity within the legislation that we can argue whether it's right or wrong or annoying, but I agree it's annoying. But there is this complexity where insurers won't allow you to increase your cover unless you've gone through an advisor. So if you don't have any commissions on your policy, then the level of cover you set up today, unless you only ever think you're going to decrease it, may not be appropriate on the long term. So the reason why we've structured our business is because I genuinely believe it's in our best interest of our business, best interest of the insurers, and the best interest for the clients to have this structure. And we do charge a fee as well up front. And the reason we do that is because we don't want to feel like we're incentivized to just make a sale on insurance. We want to give great advice up front, whether the client walks away and takes out cover or whether they decide not to go ahead at all. So that's why we feel like there's this fair value exchange up front to charge that fee. Because in the past, when we haven't done it, and I've done insurance for friends without it, and they've chosen not to take out cover, there's always this awkwardness of them feeling like, well, we've gotten value from this, but we just don't want the insurance, which is reasonable. And so do they go ahead with the cover even if they're not sure they want it, or do they pay us a fee after that? So we've decided we'll charge an upfront fee. There's a value exchange at that point in time, whether they go ahead or not go ahead.
I think most people in the Rask community are happy to pay fees, to be honest, or at least I hope they are, because I think one thing that we've realized in not dealing with, say, for example, online brokers that do free trades and free this and free that, I think what people are starting to realize in our community, Phil, is that we've taken definitely the higher road and it costs a little bit more sometimes, but you get a better experience in multiple ways. And that also translates, you mentioned mortgage broking, the similarity between getting mortgage broking advice and having a mortgage broker facilitate the purchase of a home. Oh gosh. I was one of these kind of like independents, like freedom fighters, like I can do it myself. And then that was a bloody nightmare. Like I was just so, even as a qualified mortgage broker, this is a crazy thing, trying to act like I wasn't practicing, but like even as trying to do all this stuff, I was like, this is a nightmare. I'm just going to get Chris to do it from Flint. I was just like, you just do it. And they did it. And then they checked the policy. They not the policy, the loan, and they checked to see if it's still competitive, all this sort of stuff. I'm like, God, this is so much better for me. So I'm totally cool with it. I get why some people don't want to do that, and that's fine. I'm sure there's somewhere else for those folks to go. I just wanted to go on.
And just to address that more, I think coming back to this misconception that we did in this last thing, that most people feel like the commission is boosting up the cost of the cover. And yes, you can scope out the commission and it does reduce the cost, somewhat. But the reason why, same in mortgage broking, and I will deep dive here because I get a bit excited about this, but the net interest margin on loans is decreased as mortgage brokers has increased. So the introductions of mortgage brokers and the growth of mortgage brokers has meant that the interest rate margin, so the profit that a bank's making on their home loans, has reduced over time. And so And the reason why is because it's more competitive. If you're going through a broker and they're tendering to the market and looking at 30 banks, then they'll make a choice on that. And it's the same in insurance. When you go through an advisor, we basically tender the policy and look at, and it encourages this competitive behavior. Now, there are some negative competitive behaviors that I won't call out too much, but it means that there's competition. When you go direct to the super fund, TAL has already got the contract with Australian Super that they signed 3 years ago. And so they only need to be competitive once when they tender for that contract, and then what happens after that doesn't really matter so much. But going through an advisor, you've got a market there where we can recommend. And also, just to pull back the curtain a little bit, insurance companies, they want to work with our business. We're one of the top introducers of insurance policies in the country, and they legally can't give us any extra benefit. So the commission rate is all standardized. They can't pay us anything else. There's no incentive for us to write one insurance provider over another. But what they do is they offer our clients a reduced premium. So one insurer gives us a 5% discount than you would get at other advisors. Other insurance companies provide what's called a loading discount. So they'll give our clients benefits because they can't give us any, they can't incentivize us. So they actually give it onto our clients. So if you go with that one insurer versus going through us, you may get other extra benefits. But I try not to talk about that too much publicly, not because I have an issue with it, because I don't want to sell, hey, that's the benefit of coming to us is we're going to give you a 5% discount. No, there's so many other reasons why you should go to an advisor.
Yeah. Amen. I was actually, shout out to NAB, give me a loan. I'm actually going through the process with them. We bank with them for business, and we're trying to go through them for a personal loan. And I was just curious, just going onto their website to see, like, we've already got the terms and whatever, and the interest rate that we've got versus what someone could just get off the shelf. It's significantly different, like the rate that we got through our broker, which is not always the case. But I was like, whoa, what? Of course. So I have to do less and I get a good deal. Like, okay, I'll just do that.
I mean, I had done broking in the past, and I use a mortgage broker now, like without fail.
Yeah. It's interesting because, like you said, it has become more competitive than ever before, and mortgage brokers now dominate. And you made it, actually, not to spend too much time on this because we want to get to the actual insurance, but you made another point. I think it was in the comment in a different comment to someone. I don't know. But these big insurers that you deal with, they don't have financial advisors. Like, you can't, like you said, you can't call them up and be like, hey, what's this thing in my policy? Because they just won't answer it or whatever, So in effect, what the insurers are doing is they're effectively using you as someone that answers all those questions, so they don't have to employ someone to do that, which would cost them money.
That's right.
And would increase the cost of everyone else's cover because they've got to make a profit. So I think that's an interesting point too. But anyway, enough of this digression. Let's get back to the task at hand, which is lump sum insurances. Okay, why are we calling them lump sum insurances? Seems pretty, like, it says it on the tin, but why is that?
Yeah, so lump sum means if you qualify for a claim, you get the payment as a once-off. So that's what we're talking about, lump sum. So life insurance or death insurance, you're dead, here's your money. Here's the lump sum payment. If you're considered totally and permanently disabled, for almost all contracts, there are some funky ones, but you get a once-off payment. Here's a massive amount of money, whatever you're insured for, that's what you're covered for.
Okay. So that would make sense for certain things. So can you tell us a little bit more, like, I guess, what is the difference? Like, so maybe a case study, or just like kind of intuitive and makes sense. Like with death, obviously someone dies, unfortunately. But like, can you distinguish the two for us, similarities and differences?
Yeah, so I'll talk in a bit more detail about the different types of policies, so and why people kind of need it. So death insurance, it's a lump sum payment. Like, if me and my wife, we've got 3 kids, 3 girls. If I passed away, that's a significant impact on our family from an income point of view. And my wife is not doing any paid work at the moment. And so there are sometimes people thinking, well, if they're not doing paid work, do we need life insurance or any insurance? And I can tell you, my wife went to Morocco 2 years ago. She's about to go to Canada this year. I can tell you that it's chaos when she's away for 2 weeks. And so there needs to be a significant amount of, capital injection into the household to fund, me taking time off work. I don't want to be like, life is normal if my wife passes away. I need some money to be able to just completely switch off, focus 100% of my attention on my girls and their well-being as best as we can. So that's kind of the purpose of life insurance. If you have people financially dependent on you, then you probably need life insurance, is my view. Disability insurance, now that's kind of the lowest likelihood of happening but the highest financial impact of happening. So if you're totally and permanently disabled and can never return to work again, the level of claims that are paid out is the lowest, in terms of the amount of people who are considered totally and permanently disabled. But you can never work again. And so the technical term that I like to use is you're stuffed financially. And so as much as you may think, hey, we've got all these investment goals, or you need income, you need the ability to earn money to have those financial goals. So that's kind of the purpose of a TPD payment. And you can subsidize a lot of that loss of income with income protection, and they will pay out at the same time. So you can get paid a monthly income protection payment as well as a lump sum payment for TPD. And then trauma insurance is the third one, and that's for specific medical events. So, I have cancer. You don't, a lot of people think that, hey, do I need to prove that I've spent money on medical bills to get paid that? It's not health insurance. You're not getting rebates on specialist appointments, just a lump sum payment that gets paid out if you qualify for it. And so the purpose of it is, the way I think about it is, if I had cancer, I want to take time off work. If I had cancer, I want my wife to be able to put her, we want to get the kids looked after. We want extra support. And same, if my wife was to be sick, I personally won't be able to claim on my own cover, but I'm not going to be here for a year. There's no way I want to be at work while, my wife's going through chemo and having this life-altering event. So that's what trauma policy is for, and that's kind of when we talk about how much cover we think about getting, they're the type of things that we consider. And it's just a lump sum payment, whether you spend the money on the things that you think about or not. It really doesn't matter. The insurance company pays you that lump sum cover. Same with child's cover. It's the same type of thing. It's a mini life insurance and a mini trauma cover all rolled into one. So again, if something happens to one of my girls, my personal insurance won't pay me out because I'm not ill or injured, but I want to be taking time off work. And so that's what that lump sum will just pay out, and we can allocate those funds however we want.
Cool. So there are 4 by my account: life, TPD, trauma, child's cover. Do any of them more popular than others? Like, is TPD and life more popular than, say, trauma? Or like, is TPD more popular than trauma?
Yeah, so your super fund can't set up a trauma policy for you. So the only way to get trauma is you've got to actively go and apply for it, either direct to the insurance provider or through a financial advisor. So, and trauma can't be funded through super money. So life insurance and disability, most super funds have an obligation to consider, or they do, they've got a legal obligation to consider their members' insurance needs. So that's why a lot of super funds, when you join the fund, they'll set up life, TPD, sometimes income protection. So they are more popular. Child's cover is the least popular for sure. Most people probably would never have heard about it. And trauma is, if you go through a financial advisor, there are, media commentators in the past who said trauma is, a sham. It's the most claimed on cover by far. The biggest insurance company, I got an email today, they've paid out $4 billion in the last financial year. 19% of that was because of cancer. And that's the major trauma event that is paid out on.
That's going to be my next question. Say I have all 4 of these policies, and they're good policies. We're obviously talking general, right? That we can't be specific here. So really important for people to understand. Just generally speaking, I'm diagnosed with cancer, right? Touch wood. And it's not good, right? So got to go through a lot. And I hate to bring up for people that have been through this process as well. I know how insane it is. So it's a tough part of your life. But I've got all these 4 policies. Been through the specialists, so I've got a second opinion from a specialist, and they're like, it's not good news. It's a 1 to 2 year type thing. In such a general situation, what are the things that would kick in if I'm appropriately insured?
Yeah. So, I mean, one of my close friends earlier this year passed away. So I can talk about his claim experience exactly. Okay. So he was diagnosed pancreatic cancer 12 months prior to passing away, and he was able to get income protection, which is going to be the next episode. So he got monthly payments for being off work. And he also was assessed under the trauma policy. So got paid out the full trauma policy as well. So, and then over time, prognosis was not good. And then he got a terminal illness diagnosis. And the doctor said, hey, you're unlikely to survive past 12 months. At that point in time, what we did is we applied for the life insurance policy, because not all life insurance policies, but a lot of life insurance policies will have what's called a terminal illness payment. And so we applied for that. And that was super important to him because he was the sole income earner of that household. And it was so important for him to have the mortgage cleared and to know the money was in his bank account before he passed away. And so that was the experience. He got an income protection all the while he was off work. So for 12 months, he got that trauma payment up front initially when he was diagnosed, and then got that terminal illness payment. And if he if he didn't have a terminal illness diagnosis, once he passed, then we would have submitted the application for the life policy then.
Okay. But in the meantime, his mortgage hopefully would have been serviced, at least in part, by the income protection policy that was already kicking in from his inability to work.
Correct.
Yep. Okay. That makes sense. So for just as a bit of a curveball, more or less important for people that are self-employed?
For lump sum covers, my view is if you're reliant on your income, you should have insurance. So income protection is a little bit trickier when it comes to self-employed, and we'll touch on that in the next one. But lump sum cover, like sometimes you may want higher levels of cover for trauma if your actual income is, if you're self-employed and you're living off a certain income, but your tax return says something different, you may want to increase these lump sum covers because they're not reliant on your income at time of claim. But your income protection is always reliant on what does your tax return say at the time you're claiming on it.
Right. That was going to be a question for the next episode. So we look forward to hearing about income protection then. Okay. So I did have a question here about like different features and different things that might go into these things. So rather than just like the high level trauma pays out under these specific things, I guess one of the questions is like talking about it is like, if I have TPD, is that, and I get a payment for TPD. So does that come out of the life insurance amount? Like, how is that separate? Like, can you talk us through those different types of things?
Yeah, no, that's a good question. So you can have what's called standalone policies. So I've got $1 million of life insurance, $1 million of TPD, and 100,000 of trauma, and they're all standalone policies. So if I claim on my TPD, I've still got my $1 million of life insurance. If I claim on my trauma, I've still got my $1 million of the other covers. Or you can link them together. So they're all like a pool of money. If you claim on trauma, then the other two sums, well, if you claim $100,000 on trauma, your TPD and life will come down to $900,000. If you claim on TPD, well, that removes the ability to have a life insurance policy. There are some features in terms of like what's called buyback. So you can basically have it built into the policy where if you claim on your TPD, you can effectively bring back that life insurance policy. Now, in terms of why you should link or not link, we've got a philosophy at Skye. We like to link the covers together because overall it makes it much more cost effective to link the covers together. And often these things can be, not often, but like something like the trauma event that my friend, he actually had unlinked trauma cover, but it wouldn't have had a huge material impact whether it was linked or not linked. The philosophy around linking life and TPD is for young people, especially your TPD requirement in terms of the amount of cover you need is often heaps more than your life insurance requirement. And the reason
because you've got longer to live.
Exactly. Yeah. It's crass, but it's cheaper to die than to be disabled. And so that's why we link them together often. If you go through your super fund, it'll almost always be linked. If you're increasing it through your super fund, they'll link them together. But there are, it's just generally called linking within your policy. So if you are looking at your policy, trying to work out if they're one pool of money or separate pools of money, it'll often be called linked together.
So another question that comes through our community a lot is, can I have more than one of the same policy? Like, could I have 2 life insurance policies? Like, yeah, it's going to cost me more, but I got 2.
Yeah. So the answer is yes, with lump sum cover, as long as, so when you apply for any insurance contract, they'll always ask you, do you have anything else? And if you're lying, if I've got $2 million of life cover and then I say to that new insurer, no, I don't have any cover, and I get a new $2 million worth of cover, the second insurer may have an issue at claim time. But if I say, yep, I've got $2 million over here, but I want another $2 million, and they offer me that $2 million, then you'll get paid out that full $4 million. You just got to apply for a claim on both of them. So there is sometimes a reason to do it, but it's pretty few and far between. We don't like to do it at Skye because it's just, sometimes it's a matter of thinking about, like, there's an application experience that could be more painful, and we're comfortable making it more painful to make your claims experience incredibly easy.
Yep. And you wouldn't know that. Like, people would just think they're stacking up things on top of each other and they're getting a better thing. But if they're not stacking it up the right way, it's just going to fall to pieces if push comes to shove. So if I tell them that's the most important thing, you actually bring up something else, which I wanted to double click on. There is a duty of disclosure, right? The reason that you guys ask a million questions at Skye when we come on board as clients is because you need to know, because you need to feed that information back. And there are some like fundamental principles, if you will, of insurance. And I can't remember what they are off the top of my head, but there are some of them that it's just like full and honest disclosure, right?
Yeah, it's duty to take reasonable care, not to mislead the insurance provider. So it used to be called duty of disclosure. The obligation was actually on the policyholder in the past, so it was much more restrictive. The insurers could be much more douchey around their assessments. They could be really, really bad behavior of going, well, you didn't tell me about this little obscure thing, and the duty's on you to tell us, so we're going to decline a claim. Now it's called duty to take reasonable care. As long as I can prove I've taken reasonable care not to mislead the insurer, then happy days, all good. And where we see it fall over in our business, we take medical disclosures way too serious, probably. We take it really serious because we want to, again, it's about, yes, it's more painful up front, but we want to make sure that claims experience is much better and much smoother, because we help clients with claims, and it is the most stressful time. When you have a medical event and your finances are impacted by it, you don't want to be having an argument with the insurance company because it is incredibly stressful. So that's why we do a lot of that grunt work up front to make sure, as best as we can, nothing's foolproof, but as best as we can, make sure that claims experience is much smoother for our clients. But yeah, there's a duty to take reasonable care. And one thing that we see a lot that falls over is when clients have gone to their super fund and increased their cover, they're on their couch and saying, yeah, I want extra cover, do the quote, and then, basically tick yes or no to a whole bunch of questions. And you can do it on your laptop or on your phone these days because it's very intuitive and easy. But often things will just get non-disclosed. With the amount of times we've had clients say no to any mental health condition, symptoms, or treatment, but are on a mental health care plan. And so we're like, well, you didn't disclose this accurately. Like, are you aware that there may be concerns and issues at claim time? That's a lot of the times, where there's a bit of issues when clients go and increase and don't take that disclosure seriously.
Yeah, crazy. That was actually one of the questions that I've got. I think it's in episode 4 for you. I was going to tell you a little bit about like the insurance setup that I have and how I got here. And probably the reason that I'm coming back to do it again through Skye. But this is this kind of, I think, takes us through like the essentials of life, TPD, trauma, and to an extent, child's cover, sorry. Obviously, people are starting to get the picture already that if you mentioned it in this episode, you said if you have people that depend on you, this is when things get serious. Or if they're going to depend on you in the near future, this is when things get serious, and you should not miss anything. You got to dot your I's, cross your T's. And if you're not prepared to go deep into this world, I would suggest getting expert support on this matter of your finances, obviously. But at the end of each of these episodes, Phil, I do ask you for one thing. Got in my notes here. One thing that people can take away, one thing they remember, one thing that they just get from this episode in particular. We're talking about lump sum. It might be that. It could be something different. But in the last episode, you just urged people just to be aware. Just to know what they have in place already. Like, they're not specifically, just generally. What about for this episode? What's something that you would ask everyone listening or watching to think about?
Yeah. So, I mean, one thing we didn't go too deep into is how to think about the level of cover that you want to get. But that's probably my thinking is, look, episode 1, you've checked what you currently have. Now compare the level of cover you've got and you've been provided or you've set up externally, and then think about if one of these events were to happen, how much money do you reasonably expect to need? So if you were to pass away, do you want to clear off your mortgage? So, for me, my wife isn't paying a mortgage with no income. That's important to me. Now, once the mortgage is paid off, do we need an income that's been lost to be supplemented, and for how many years? So the way we think about it a lot at Skye for life insurance, we want to cover mortgages if there is a financial dependency, and we want to cover that loss of income minus the mortgage repayments. If that's being paid off, we don't need to factor that in, and minus the tax, because life insurance is often tax-free if the money goes to a financial dependent. So we want to cover that for a certain number of years, whether that's until your kid's 18 or whether that's just 10 years or whether that's 3 years. And, my wife can reasonably expect to get another job within 3 years, then maybe we only need to replace my income for that long. So my call to action is really just about, now that you understood what you've got, think about how those numbers that you've got, is that reasonable? For TPD, if you're never able to work again, is the $134,000 that you've got covered within your Australian super fund, is that reasonable? If you don't have income protection and your income is an average income or even a low income for an Australian, is that a reasonable amount to be covered? Even if the likelihood of you being TPD'd is so incredibly low, it can happen. And so just think about, that's kind of my major takeaway, is thinking about, if something was to happen, how much money do we actually want to have?
Yeah, good points all around. So the key point that you said is it reasonable? And I think a lot of people struggle to imagine that they die tomorrow or they're incapacitated tomorrow. Like, even for me, I never would have thought that I'd get laryngitis last week. I've never had it before, right? So it completely blindsided me. But I now realize how vulnerable I am to my voice. And anyway, need to see a speech pathologist maybe who can give me some strategies. But my point is that we don't often know exactly like what could go wrong, but just getting yourself ready and prepared to think, would my family have enough? Do I have enough if something goes wrong with them? Not just now, but as the kids grow old, right? It's not just the school fees today, it's the school fees next year and the year after. So just reasonable. What do you think? Mate, this is great. This is a link to Skye, trusted partner of ours, in the show notes and episode description for everyone to go and book in a call with your team. So I really do appreciate your time on the show today.
Awesome. Thanks, mate.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.